touch on that rather touchy subject of interest rates. Where could interest rates go? Where should interest rates actually be at this point in time based on market conditions and economic conditions generally? So let's take a look at what are the key drivers for interest rates, and we are focusing particularly on the monetary tool, the repo rate, to impact interest rates across the board, whether it be deposit rates, whether it be lending rates. So let's start by looking at some of the areas we will touch upon. Of course, we are talking about TT dollar interest rates, its outlook, as well as what will happen further out on the yield curve in terms of fixed income opportunities and possibilities. Why are interest rates important in any event? Well, we cannot overemphasize the importance of interest rates, because as all investors know, when interest rates go down, fixed income, bonds, etc., valuations go up, and vice versa. So what could happen with interest rates will impact our investments in terms of our bond holdings, as well in terms of the equity side of the equation. Lower interest rates impact corporate earnings, and corporate earnings impact equity prices. Very important then, the deliberations on interest rates and having the correct pitch for interest rates. Let's look now at what is happening with regard to one of the primary policy impactors on interest rates, and that is the central bank repo rate. Of course, the central bank repo rate is a policy marker that is intended to send a signal to the banks as to where interest rates are likely to go, whether up or down or simply floating across. And what we see on this particular graph is that the repo rate going back to December 2012 or thereabouts was flat until about August 2014, July, August 2014, when we had 7 or 8 consecutive increases in the repo rate by 0.25% tranches up from September 2014 to December 2015. So that the repo rate starting at 2.75% in August 2014 would have climbed up to 4.75% by the end of 2015, that is December. What has happened since then is that since December 2015, over the past 2 years and the change, you would have a flattening of the repo rate, no movement either up or down. And it being the main policy driver, the question is the repo rate at the proper pitch to influence and impact what is going to happen generally to interest rates across the board? So let's look at moving forward into what has happened to now. We talked about at that time, at the end of December 2015, the central bank noted the following as drivers for the repo rate increase. One was the reason for upticks in the repo rate was there was an acceleration in headline inflation, that is, headline inflation moving upwards. Then there was a positive growth in the non-energy sector. So just to make sure that the economy was at the right temperature, if you want to call it that, the repo rate had to be adjusted upwards to, let's say, cool any overheating in the market. And then, of course, the third reason given by the monetary policy announcement was that the upticks in the repo rate were to mitigate higher capital outflows caused by a narrowing of the TT-US dollar interest rate differential. At that point in time, of course, there was relatively easy access to currency, as well as the question of any gap in the unofficial or official rate was somewhat moot, meaning at the current point in time, we are hearing on the street that it would take 8 TT dollars rather to buy $1, whereas at the official rate, even now, it's $6.78. Unless and until that gap is closed, there are reasons to be concerned about whether the TT US dollar interest rate differential in terms of interest rate across the board, whether at the short end or out beyond 10 years, whether they would be impactful to the investor. So let's go forward now and take a look at what has been happening now. So now in March 2018, April 2018, the monetary policy announcement, the central bank has spoken to its reasons and rationale for holding the repo rate constant. First being low domestic inflation. And when we look at that inflation, what we would have seen in that report is that headline inflation was 0.9%, 0.9%. That food inflation was 2.6%, and that core inflation stood at 0.5%. So yes, low inflation. Secondly, in its announcement, the central bank spoke to the recovery in the energy sector in late 2017, having not yet filtered into the non-energy activities. And third, as a reason for keeping the repo rate constant was, among other things, to mitigate higher capital outflows caused by a narrowing of the TT US interest rate differential. So that's then, and this is now. And let's look at what has been happening in the intervening period to comment further on where interest rates, in my respectful view, ought to be. Well, first of all, low inflationary pressures. Let's look at what is happening there. Quite rightly so, what you could see on your screen are three lines. The red line, which gives the movement of food inflation over the period December 12 to December 17, that is within that 5-year period. And we could see that from a peak of inflation, food inflation that is, of 18.2%, what you are seeing, that is in September 2014 or thereabout, you are seeing that the rates have come down, and they have come down to 2.6%. Let's look at core inflation, that blue line. When you look at that blue line in terms of core inflation, you are seeing a drifting downwards from about 2% in 2012 down to 0.5%. And then headline inflation, which we are tracking, headline inflation peaking at 9% in 2014 and has, as you can see on your screen, drifted downwards down to a level of less than 1% or 0.9%. So if we look at those things, yes, inflation has actually fallen away. And much of this, let's be clear, much of this inflation is not inflation caused by local production. Much of it is imported. My guess is that just about 2/3 of our inflation is imported in the context of goods and services of the overall pot of imports. So what does that mean? In the context of the repo rate, low inflationary rates should argue for an adjustment in the interest rates on its own because of the fact that in current economic and market conditions, there is need for some stimulus of activity in the economy, whether it be on the consumer side, whether it be on the business side, but there is need for some stimulus. Not much room for fiscal stimulus, but on its own, monetary stimulus in terms of an adjustment downwards of the interest rate makes good sense for the market and for the economy. Second point is the question of declining domestic economic activity. Let's see what's happening here now. When we look at domestic activity measured by real GDP, what are we seeing over the last 2 to 3 years? Let's look at the last 2 years, 2016, 2017. We've seen a decline in GDP of some 6% in 2016 and a further decline in 2017 of 2.3%, negative 2.3%. Even though there are expectations for some uptick in terms of GDP into positive territory at a level of just under 2%, 1.8, 1.9%, we'll wait to see what's going to happen in 2018, driven by higher energy production, both in terms of gas, but not so much in terms of oil. So domestic activity is in declining territory or muted, to say the least. And therefore, it makes sense for the policymaker to think in terms on the monetary side, what needs to be done with interest rates. I can say that there is capacity, and we'll talk about that in a little while. So let's go now to some of the other arguments, and an argument that we are making. There is liquidity in the system to be able to carry an adjustment in interest rates, meaning the supply-demand configuration, there is an overhang of supply. So there is capacity to adjust interest rates and to have the liquidity to be able to impact the economy with lower interest rates on the expectation that it will enhance activity, economic and market activity. And of course, the 800-pound gorilla in the room is the question of the currency exchange. And we are going to come to that after we speak and have a look at the question of liquidity and persistent excess liquidity. If we look back again from December 2012 to the current time, what we are seeing is that your red line is the increase in the repo rate, which we have spoken about previously, up to 4.75%. But what we are seeing in the yellow line is, as you track that yellow line, you are seeing that there's this constant overhang of liquidity, that is funds so in excess in the system over what is being borrowed. So even though it was much higher, as you can see, in the period up to the end of 2015, ranging to about $7 billion, it has now come down to just under $4 billion, and it has been hanging about in that $2.5 to $3.5 billion in the system. That is in the context of local TT dollar deposits being something in the order of about $75 odd million, the rest being made up of US dollars of the $100 billion or so, TT equivalent in the system. So there is opportunity and there is capacity for adjustment to interest rates. Opportunity is to give a kick to the system, and capacity in terms of liquidity that is available in the short term to address this question of wither interest rates. Now, even if liquidity is mopped up in the system, as we just talked about, our reserve requirements or our deposit reserve, the primary deposit reserve, is probably, not probably, it's the highest in the Caribbean when we look at some of our peers. Barbados being 5%, Jamaica 12%, Guyana 12%, Bahamas at a lower level, and Belize at 9%. So if you take that liquidity down from 17 to even 12%, you still have the capacity to put more funds into the system in case of need. And that is what I'm saying in terms of capacity, surplus liquidity, as well as tapping into the reserve. And that 17% masks the overall withdrawal from the system in terms of other hidden reserves. If you speak to bankers, they would say the reserve requirement, the primary and other reserves, takes you up to 25 to 27% in monies being mopped out or drawn out of the system. So yes, the fact is that there is capacity. Why not? Why not adjust to promote economic activity in general in the system? And that's a question that we need to have answered in going forward. Now, I spoke to the question of the 800-pound gorilla in the room. And we have been hearing commentators speaking about the interest rate differential. Now, when currency is in balance, that is, it is the exchange is at or near market, then, and there is access to currency, then the interest rate differential can be a useful tool. However, in the current system, where there is an unofficial rate, and we are hearing exchange in the unofficial market at the rate of $8, $7.50 to $8, whereas in the official market, it is in the $6.70 to $6.79 vicinity. Massive difference. And therefore, let's look at it from the ordinary man's point of view. If you are telling him, place your money in TT dollars and we will give you 1%, 2%, 3% more than the US dollar rate, it does not cater for and address properly the question of a market rate and currency, because there is always the fear and the concern that you can be seriously battered and overcome by the interest rate, not by the interest rate differential, but by the currency. And therefore, this TT dollar interest rate differential is really a non-issue in the question of where interest rates should be, because it cannot impact, it cannot cater for, it cannot deal with that massive the currency differential in the official market and the unofficial market. So, going forward, we take a look at that interest rate differential. And what do you see? You see in the interest rate differential, in the shorter end of the market, that is 3-month treasury rates, what you see is a negative position in terms of the TT dollar to the US dollar. That is, the TT dollar is lower in terms of the interest rates than US dollar 3-month treasury. But that is this yellow line that we are looking at here. And what has been happening to it over, let's say, from August 2014 to now. So when you had this differential here at this point in time, in 2015 or so, what you were able to do when there was reasonable access to currency and there was not a big gap, if any, between the unofficial market and the official market, then it would have made sense. It does not make sense here in the short term for reasons which we have already given. And then if you look at the red line, which is 10-year Treasury, what you see is that our interest rate differential in 2016 peaked at about 3% versus the 10-year rate in US dollars. That has, of course, that has come down. That has come down to 1.5. And I continue to argue that whether it is up or down, the real issue in the market is what is happening with the exchange rate, both in terms of access and in terms of the unofficial versus the official rate. Ineffectual, and I think it is not the policy measure that we may want to rely on to slow the flow or the perceived outflow of currency and capital. So let's go on now and have a look at this question of interest rate differential, what the IMF is saying, what the central bank is saying, and our view. I have articulated that a lower TT-US interest rate differential has a limited, if any, impact on capital flows. Capital outflows will continue as long as there is that gap in the currency. And until the official exchange rate is at or near market, the TT-US interest rate differential will be ineffective in influencing such capital outflows. I want to draw your attention back to the last in our webinar series in March, which we quoted the IMF that a conversion on foreign exchange, we noted that the IMF staff assessed the real effective exchange rate to be overvalued by around 25 to 30%, and this is in 2016. And that has come to roost so much so in terms of what investors and those who require currency are seeing out there in the official versus the unofficial market. So I reiterate my view that this is really not a relevant, effective policy measure in the market conditions that exist today. And that cannot be overemphasized. Now, what happens with regard to the interest rate scenario existing at this point in time? Who are the winners? Who are the losers? Well, in terms of the winners for lower interest rates, I question whether there would be much in terms of a lower cost of funding, because as you would see in a subsequent graph, the deposit rate on average, figures taken from the central bank, has been about 0.2%. So will there be any adjustment in terms of the adjustment? So the winners in terms of the lower cost of funding, the winners at this point in time are the commercial banks. If you move interest rates down, I don't see any insignificant improvement benefiting the commercial banks. Winners are, from the point of lending, the commercial banks have been able to increase their lending rate, that is the prime rate indicator, even though there is a surfeit of funds in the system. So even though there is an imbalance between supply and demand in the system with the supply overhang, the movement by the central bank, which is the cue to adjust in interest rates, that is the repo rate, has resulted in much higher lending rates. And the question is, do we need such high lending rates in a market and an economy that needs some sort of stimulus, and there is a capacity to provide that stimulus, and there is an opportunity to provide that stimulus? Who benefited as interest rates went up? higher interest rate spreads have been to the benefit of the commercial bank. Of course, that has been tempered lately with the adjustment in taxation, which have been targeted to the banks, moving tax rates up effectively to about 35%, which is about 5 points more than other players outside of the banking sector. Losers? Well, we continue to have very low savings rates. And going along with that, in terms of the short end of the market, low investment returns. And savings have been eroded by inflation, somewhat less so lately because inflation rates have been falling, whereas savings rates measured by deposit rates have remained relatively flat. Let's see if we have a graph that can show this story. So here we have what has been happening, and we talked about the movement in the central bank repo rate. This is the movement up, the 7 or 8 adjustments up, and that flattening there. Excuse me. What we see though is that the deposit rates, or the cost of funding, if you look at it over the entire period, has been at that 0.2% on average. And if that is the case, then what we have seen from about the middle of 2014 is an increase in the spread, in bank spreads, taking all other factors as holding constant, from 7.3% to 8.98% spread. So that's why I talked about the winners and the losers in this higher interest rate environment, which is not supported by what is happening with liquidity, which is not supported by what is happening with regard to inflation in particular. And by the way, while many other countries have already set, or the country's central banks have set targets for inflation, we have not heard from the central bank with regard to what, if any, targets are set officially and published with regard to what should be target inflation rates. So is it that we are generally just going with the flow, or is it that there is some specific range that the central bank has? We don't know. This is becoming a part or a factor in the international markets, where most or many of the developed central banks have set a target. You can see it in Brazil, you can see it in India, markets in which we operate, of course the US. And therefore the question is, do we need at this point in time to have in place a target range so that investors can better understand what is in the mind of the central bank going forward with regard to its own interest rate policy? So let's take a look next at, and we've talked about this, the benefits of lower interest rates. And so we don't need necessarily to belabor the point. Lower borrowing costs for consumers could stimulate activity. Reduced mortgage rates could also stimulate activity. Likely increase in equity prices, as we said, interest rates lower, corporate earnings likely to go up, and that should give some sort of fillip to the equity market. Economy, lower cost of borrowing for commercial banks. I've said this before, not likely, because the cost of borrowing, deposit rates are already so low. A lower cost of borrowing for government, it depends. Where on the yield curve does the government want to raise money? They have been raising money at the 10-year marker, 15-year marker, but there is room for the consumer sector for borrowings, let's say 5-year money, 7-year money, and so on, that might be attractive to consumers if the government comes in at the right rate. Higher levels of spending and investment, if investors can borrow at a cheaper rate, the theory is that they will do so if they can find proper opportunities. And this can and should lead to higher economic activity. Those are some of the arguments that we will put forward for lower interest rates at this time. Of course, there are drawbacks, but I will say that the upside outweighs the downside in terms of what's possible lower savings rates. How low can you go? Higher inflation levels. Well, I think we are a long way from higher inflation levels, but that much of that inflation really depends on our imported inflation. So we are, in a sense, inflation takers rather than controllers of inflation in the bigger picture. Outlook for inflation worldwide, we can't really say, except that it has been at the lower end of the scale for quite some time, and even players around the world are baffled when you see economic activity taking off, but inflation not generally rising, particularly in the US. So the role of the central bank versus the US Fed, of course, there are differences in the role. Our central bank objective is to maintain low or stable rate of inflation, to manage orderly foreign exchange market. And I question whether an orderly foreign exchange market is being achieved when the unofficial rate is so far away from the official rate. Adequate levels of foreign exchange reserves, yes, we have that. Of course, the main difference is that the US Fed has a duty to create or maximize employment. Those are our thoughts. In concluding, I would say that I'm just showing here inflation target rate before conclusion, which shows that countries adjacent to us, close by in the Caribbean, Latin America, have target inflation rates, but we don't. And if we do, we are not aware as the public with regard to what is happening there. So I turn now to the question of some of the IMF views. Their arguments are low inflation should argue for lower rates, fall in demand should argue for lower rates. We agree as far as that is concerned. However, we differ in terms of the question of the currency, that the interest rate differential will impact or retain savings and slow the capital outflow. Our view, the TT interest rate differential will only be effective if there is access to currency at the official rate. Closing of a gap between the official and unofficial rate, I reiterate, will help considerably in having a market currency as well as market interest rates. Now, what's in it for investors? Before we close, what's in it for investors? Well, we have said before, and we continue to say, that you need to go longer on the curve. As you go out, look at 2017 results. You can see the equity market generating 4.69. You can see the local bond market as you go out to 10 years and so on, generating about 4.36%. Also, the other factor that investors must look at is look for investments that will create a currency hedge, whether in full or partially. That's why we have supported in terms of our outlook, we have been keen on certain stocks that give a full currency hedge and even those that give partial currency hedge. So in concluding, I reiterate, we at Bourse hold the view that there is scope and opportunity to lower TT interest rates. It should be done now to stimulate market activity and towards growth in the economic and activity and GDP. And mainly that the upside in terms of the arguments, outweighs the downside in terms of the impact of lower interest rates on market activity. So I will close there and open up for questions. If I cannot answer these questions at this point in time, we certainly will send you a follow-up answer if research is needed. So the first question that I see up on the screen, why haven't deposit rates increased with the repo rate? And that is because, in my respectful view, that there has been for some time, as I showed during this presentation, a significant overhang in terms of supply within the banking system. We've shown that from 3.8 billion as it stands now, the overhang was 8 billion 3 or 4 years ago. So been that consistent, persistent overhang of liquidity. And the repo rate was being adjusted to sort of cool the market. But now there is need for the repo rate, which is the policy marker, to seek to give some positive impact or stimulus to activity from the monetary side. And I feel that in that context, the central bank may need to act more swiftly to bring about the adjustment to lower interest rates that may be needed at this point in time. Next question. What advice do you have for accessing FX for importation business? Well, I used to say that was the $1 million question, but that really now is the $1 billion question. How do you access currency? So we have a situation where businesses are not getting access, or certain businesses are not getting the level of access that they need to continue to run their businesses. Should we consider more of an auction system, a market-determined system for who is prepared to pay what for the currency? And I think that that is closer to the mark in addressing the differential between the official rate and the unofficial rate. But that is a question that has to be determined by the policymakers. What I can say is, as long as you have subsidies in whatever form, you are going to get people who will be able to work the system to their benefit, but not necessarily for the overall benefit of citizens. What is the relation with the repo rate and the mortgage rate? Well, the mortgage rate is based on demand and supply in the mortgage market, and the repo rate really speaks to the shorter end of the curve. How will higher inflation affect purchasing power? Well, higher inflation, lower purchasing power. That is the normal relationship. If you have higher inflation, it means that your money does not stretch as far and you can buy less with what you have. So lower inflation, as it stands now, gives you a different opportunity. How will closing of the gap between the official and unofficial rates occur? Well, for that to occur, there must be a policy decision at this point in time that there ought not to be such a significant gap, because in that you get a few winners and many losers. As you get closer to the market, there is an improvement in equity across the board. Next question, would the central bank lower interest rates if the currency is adjusted? Well, if those two rates, interest rates, are at or near market and the currency is at or near market, you will find a certain equilibrium taking place. The equilibrium in the main will have to be on the currency side, whereas official and unofficial rates close, then there will be less of the scramble, if you want to put it that way. There will be less of the scramble for currency, and those who are willing to pay for the currency will get that. As it stands now, those who get more of their currency through the official market are the winners, and those who get less are the losers. Next question. What is your advice regarding using Guyana dollars as a stable currency for foreign transaction? Well, we have the TT dollar as our official currency. I don't think that the question of using Guyana dollars could arise. In fact, Guyana dollar is not a world currency, and therefore I don't think that there is any kind of arguments for doing something like that. Next question. What are your thoughts on the NIF? I would say that it is somewhat premature to provide any perspective on NIF because we have not been given, in my respective view, sufficient facts and information to make a well-informed judgment. We will do that, we at Bourse will do that when all or most of the facts are on the table, when we feel we can take some position and provide some perspective on the NIF. So that's it for today. This has been our April webinar series. We invite you, if you have any further questions, to come forward and to send us your questions, and we will do our best to answer your question. I'll take one more question. Given the economy's current state, what are your thoughts on the local equity market? I would say generally the local equity market is trending down, and we are doing a piece now to be aired on television on Monday, which will speak to where the winners are and where the losers are, what are the sectors. Generally trending down. There are pockets that you can look at that will give you value, selected areas. Investors have to be far more selective in terms of what to pick. One of the days in trying to create a balanced portfolio, because that balanced portfolio will not give you the kind of returns that you want. You have to think differently in an environment such as this. Thank you very much for spending time with us at Bourse to speak about this most relevant question of whether interest rates. We'll join you again next time in May to talk about another topic of relevance and importance to you as an investor. Have yourself a wonderful investment week and month ahead.